All right, everyone. So on Empire, you obviously know that we talk a lot about the institutions coming into crypto. And that is why we are super excited to share that we are hosting the Digital Asset Summit. We've hosted this since 2019. It's coming up in London, March 18th to 20th. Don't miss your chance to get ahead of the curve. You can get 20% off with code EMPIRE20. We'll see you in London. This episode is brought to you by Toku. If you are planning to launch a token, already have a live token, are granting employees or contractors vesting token awards, or are just trying to figure out how to take care of taxable token events for your team, from easy to use token grant award templates through tracking vesting to managing tax withholdings, make it simple today with Toku. All right, everyone. Welcome back to another episode of Empire. We have Joe McCann, founder, CEO, and CIO of Asymmetric, joining us. Joe, welcome to the show, man.
Hey, thanks for having me. Glad to be here.
Yeah. So I was reading your most recent investor letter, and you kicked off with this concept of short intellectual convexity. And I thought you started off your investor letter with this idea, and I thought it'd be interesting to start the podcast with this idea. What does that mean to you, being short intellectual convexity, and why is that important as it relates to crypto investing?
Yeah, it's a great question, and I have to credit my colleague Chris, who works at the firm, with the actual phrase, but it's something that has resonated with me for a while. And so the easiest way to kind of describe it is an example, and I mentioned this in the market update as you described. So back when a call to past, well, up until a couple of years ago, we were in 13, 14 years of zero to near zero interest rates. And in 2020, when the Fed cut rates to zero and the Treasury pumped a bunch of stimulus into the system, risk assets went to the moon, right? You can't earn any money on cash, so you got to invest in stuff. And so at the time, people just couldn't envisage a world where rates are all of a sudden at 5.5%. 5.25%, 5.5%, the quarters in between, right? They were short intellectual convexity, meaning they couldn't see or forecast something like 5.5% or 5.25% rates because they had been in this environment for so long. They just couldn't see it, and naturally, what happened? the fastest tightening cycle I think ever, or certainly in a generation. Hits the tape and people took it on the chin. Now, a lot of folks are sort of like, well, rates are going to just stay higher for longer, right? The same thing, right? Now we're in this environment where rates have risen so high that why can't they keep going higher, or why aren't they going to stay higher for longer? So this is not necessarily a forecast for me to say, hey, the Fed's going to cut rates next week. The net of it is that, look, right now people are short intellectual convexity with respect to rates, and there's a good chance that rates could be cut for some unforeseen reason, and that applies to crypto, right? So one of the things that I mentioned in the market update is one of the hardest things about being a really good trader in any asset class, but particularly crypto, is when the market structure has changed, right? And so people have been beaten up, rightfully so, mentally and emotionally, probably spiritually, depending on how strong your maximalism is, over the past, call it 18, 20 months. And they couldn't envisage a world where, wait, actually things are changing. Things are going to be like, money's coming back into the system, or altcoins are going to rise, et cetera, et cetera. A lot of folks were, and still actually right now, are offsides, meaning they're not believing this rally, they're not invested in this rally, and they are short intellectual convexity in that regard. They can't envisage the world actually changing because it's been a certain way for so long. And the way that you make fortunes as a trader or / investor, particularly in liquid assets, is understanding what is that inflection point. It's really, really, really hard to do. I've been doing this 23 years, so I have a little bit of experience. I'm trying to identify these things. I've definitely been wrong in the past with identifying it, but in my opinion, we're there now. And the price action in October really suggested that. And then, you kind of look at the overall flows that have been coming into crypto related products. They're huge. And this isn't just necessarily Bitcoin. This is other things like Solana as well.
So when you say that we're there now, tell us more about what you mean by that.
Sure. So, in January, we had a huge run in a number of, crypto assets. Total crypto market cap went up significantly. You had a bunch of assets that were just completely battered. Solana being one of them, down 97% from its all-time high or whatever. And those flows, kind of managed, they kind of happened for a decent bit there in January, continued a little bit into February, and then kind of like Q2, we sort of traded a little bit sideways to lower. And then we had the ETF news in June, and that caused a bunch of additional interest, et cetera. But the reality was, like, if you looked at, spot volumes and even, on-chain volumes, they weren't even there. Right? Like, they were just dropping off at a precipitous pace. I mean, yes, you had like Pepe coin and you had ordinals and you had certain things that would like idiosyncratically spike, interest in volumes, but that's just basically, crypto natives, speculating and punting around, shuffling money, right? The difference now is, I think, is heavily flow driven. So if you look at, like I mentioned just a second ago, if you look at like the actual institutional inflows into crypto right now, they're very meaningful. The most, October, I think, was like the month that had the highest amount of flows into Bitcoin, ETH, Solana, and a bunch of other products all year. And those types of flows are not fast money. Like, I run a hedge fund and a venture fund, but on the hedge fund side, we're considered fast money. Fast money doesn't, allocators don't trade like hedge funds, right? They're not squeezing a few, percentage points here and there. They're accumulating, right? They're allocating size. And so some of the software I built at Asymmetric helps us identify when these flows are actually coming in real time on the tape. And we were just seeing, particularly Solana, massive prints hitting the tape, meaning large trades hitting the kind of, call it retail or / institutional markets, Binance, Coinbase, Bybit, et cetera, on the spot market side, not the derivatives. And when you start to see this type of flow coming in consistently, right? And you look at the charts, you're like, wow, this thing is overbought. It's got to pull back. When it doesn't pull back, that is a very, very strong signal to you that there's real accumulation from allocators coming into the space. Now, we're not talking about tens of billions of dollars yet, but on a relative basis, the amount of flows that are coming in are meaningful. Now, in addition to that, if you look at stablecoin flows coming back into exchanges, and particularly on chain, they're rising at a pretty large pace for the first time in a very long time. And so one of the questions I would get from investors earlier this year is kind of like, who's the incremental marginal buyer of crypto at this point? And my answer was, there isn't one. Not until you actually start to see stablecoin flows come back into these markets, because then people aren't necessarily speculating or investing in the space. And so, you kind of put that together. I also run a lot of technical analysis, in addition to, flows and kind of the reading the tape, et cetera. And I put all these together and say, probabilistically, there's a high chance that this is actually a change in the market structure. Sure, I could be totally wrong and it could plunge 50% while we're on this call, right? That's crypto for you. But the probabilities really favor it. And then finally, I think as you look into some major catalysts that are going to be at the beginning of next year, the halvening, of course, but also our view is really that the ETF and or ETFs will be approved in January. And so you see a lot of this in the options markets as well. So you see a lot of call buying and people basically long vol into that general strike, like that range, December, January, which means they're bullish heading into that. And so, yes, traders can be wrong. Options traders can be wrong. But again, it's just like another one of those check boxes that are checked that suggests to me that this is actually meaningful and a meaningful shift in the market structure today.
Yeah. If you look at the crypto market cap as a proxy, it really bottomed shy of just south of a trillion, right? A trillion, I believe.
Yeah.
and now you're at 1.4. So, roughly speaking, there's been 400. Some of that's inflation driven, but call it between 300 and 400 billion is, market cap expansion over the course of the year. When you think about like which institutions in which jurisdictions, do you have a sense of where that is and who's and what strategies are deploying?
Yeah, great question. So the short answer is you can never actually know unless you're kind of the dealer or the market maker. If you're talking with these, say, family offices or sovereign wealth funds, I don't believe sovereign wealth funds at this point are purchasing crypto, but they could be. What we try to do is look at what we call like the biorhythms throughout the trading day, right? So crypto, as you guys know, are 24/7, but there's specific chunks of the day where you can see differences in the flows. And so, to begin every day, and I live on the West Coast of the United States. So, at call it, I don't know, 4-ish a.m., 4 or 5 a.m. my time. So maybe 7, 8 a.m. East Coast time. You've got like the US hours. And then when US hours end, you then have the next, technical day, which Asia starts to, trade. And then after that, you've got the European hours. So if you break those up into, 3 8-hour segments, you can kind of get a sense for who's actually buying, right? And so with respect to the US hours, these are the ones that we pay attention to, particularly because a lot of the institutional flow comes through US hours and particularly through Coinbase. Because Coinbase has an institutional offering, you can kind of suss out a lot from the order flow that's coming out of Coinbase. They have their Coinbase Prime offering, Coinbase Pro, with a number of other products. I get so confused every time I log into Coinbase, but so we tend to look at US hours, what's happening particularly on Coinbase, and as that relates to something like Binance. We can't actually identify, is this a family office? Is this a hedge fund? Is this an asset manager? But what we can identify is, or I guess what we can infer from it, are the way that the flows are actually being accumulated. So there's two things that we look at. One is can you kind of detect what are called TWAP orders, or time weighted average price? So somebody that just says, hey, buy me $10 million worth of Solana over the course of the next 12 hours. I don't care what the price is. Just, keep buying it. That's one thing that we do, is we look for, we detect these types of automated orders. The second thing that I kind of tend to look at is the premium or discount on Coinbase relative to Binance. Binance, as you guys know, has the majority of the market share for trading. There's all kinds of punters on that platform. I'm not suggesting there aren't institutions that buy and sell on Binance. I'm sure they do, but very few US institutions will do that, if any, and for hopefully obvious reasons. And so if there is a persistent premium for an asset, let's say you're trading Solana, and it's, I don't know, 20, 30 basis points higher on Coinbase relative to Binance. And yes, Binance does have tethers, so you have to factor that in. But if that is a persistent premium, that suggests to us that there's real institutional allocators or people with real size that are buying, because they're willing to pay above market price relative to what's on Binance. And so if you use kind of like the daily biorhythms coupled with that premium and kind of trying to detect these systematic flows, you can get a sense that, hey, this isn't just retail, right? It's not like everybody got airdropped a bunch of money from the government and went on Robinhood and bought Bitcoin. That's just not the case right now. And you can see this in the order flow.
So what else does the order flow show right now, Joe? In terms of, I guess, both what Santi was asking, like, is it US based, maybe EMEA based, or also the other, I think, pressing question is, in terms of this specific rally, does it feel overbought, underbought, think that there's room to run, pullback coming? How do you think about like this, just the short-term trade there as well?
Yeah, it's a great question. I mean, and I love technical analysis. I've been using it my whole career, but if you were using TA, say on, Solana recently, you shorted or missed everything, right? Because it was just consistently overbought on every time frame. It's still overbought on the time frames. But the thing that I think a lot of traders miss about things being overbought or oversold is they can stay that way for a long time. And that is driven by momentum and flows. And so if for example, when Solana first kind of broke out, kind of near like that FTX implosion level of mid 30s, it was overbought. And so I think a lot of people were saying, oh, this is now going to pull back and I'll end up buying it in the high 20s, low 30s. What happened? The thing went to 48 in a blink, right? And so again, the kind of like identifying when to use TA and use like these other skills with respect to understanding the flows of what's happening in the market are critically important, because if you look at Celestia, for example, they just recently launched their token and they were kind of trading for a few days in this 250 range. Now it's trading like $6, right? It's clearly overbought on like a 1 hour, 4 hour, even potentially daily time frame, depending on your indicators, but there's flows behind it. And so I think like that's the key. And so do I think this rally has legs? I think it's also very token specific, right? So,
well, on that point, I guess I wanted to ask you, are we in this environment where you just long everything? Because,
it does feel like I'm very quickly.
It's an honest question. Like, look, at Parify now we like to over intellectualize our role as investors, but there are environments where no matter what you're punting, everything goes up. And I hate to say it, but that's just crypto sometimes. And so I am curious, are we entering that environment? How do you position yourself? There's certainly like some narratives evolving, right? Like certain L2s, stuff like Celestia, and certainly the Solana ecosystem. But I'm curious how you think about that.
Yeah, I mean, it's a great interruption question, because that's exactly where I was going with this. Is that part of the problem with this is that like you're like, oh well, I'll just long everything and it'll be fine. That's great if you're just trading like your personal account and you want to manage your own portfolio, whatever. If you have LPs like I do, you have to generate returns, and you have to do that in a way that beats a benchmark. And so no one's paying. I mean, there are lots of people that will take 2 and 20 at a hedge fund to just buy and hold Bitcoin, right? I'm not that guy, right? And so part of my job is to almost be like a stock picker. I need to identify the right assets that are going to generate outsized returns relative to, say, a benchmark like Bitcoin. And the trouble with that is twofold. One is are they liquid enough, depending on like the size of your book, right? And that's one issue. And then the other issue is that if you're not actually managing the risk of being long only everything, the volatility in your book will be crazy. And so a lot of investors, yes, they're investing in crypto. They know it's clearly volatile. They're still going to want to understand, at least my investors do, how are you managing that risk so that the volatility in your portfolio isn't triple digits, every day, right? So what I would say is that with respect to, longing everything, it's not financial advice, anything I'm saying, by the way. I think if you just picked a basket of tokens and were long them from here in 18 months, you're probably doing great. However, I do think that narratives matter, to your point, Santi. Like, narratives really matter in crypto. And if you look at, say, the price of Ether recently, you had the ETF news and Solana went up 40%. So what does that tell you? Well, correlation is not causation, of course. But I think that there's a challenge with respect to Ethereum's narrative right now in terms of price. And we can kind of dive into that as you see fit. Because one, most institutional allocators, large allocators, yes, there could be potentially this BlackRock Ethereum ETF, and that could generate a ton of flows into Ethereum. Most of them have all been focused on Bitcoin. I just need to have some Bitcoin allocation, digital gold, yada, yada, set it and forget it, whatever, right? And now I can get it through BlackRock or whomever. If you're a crypto native or someone that's actually purchasing crypto directly, like spot assets, what is the purpose of holding, say, Ethereum relative to Solana from a return perspective? And this is where the narrative comes in. So remember, Ethereum went from basically zero, it didn't exist, to 1,400, down to 80, and then to like 4,800, right? Well, Solana went from zero, didn't exist, to 260, down to $8. Well, what's the next level for Solana? even if that doesn't happen, it's the narrative that's seated in the minds of investors, right? So, for example, every TradFi investor out there now that's actively managing a portfolio is looking at Solana. And the reason is they missed Ethereum. They're like, wait a second, is this narrative could play out all over again. So am I going to over allocate to Ethereum, or am I going to over allocate to Solana to have that potential outsized return, right?
Joe, I think you're kind of we're dipping into the Solana thesis, so maybe we can go full bore Solana thesis and kind of I'd love to just hear your I mean, I remember January 2023, Solana's down 97%. You guys start talking about loading up on it at, like, I don't know, basically the bottom. Would love to just hear your full Solana thesis outside of, which I know is deeper than just, hey, I think some other institutions are going to buy it because they missed the boat on ETH.
Yeah. Yeah, the narrative is one aspect. So my background, I've been a technologist and a trader for 23 years. Ran an open source infrastructure company called NodeSource for Node.js, which is arguably one of the most popular open source projects on the planet. And so I have a good bit of experience in understanding open source, understanding kind of like software development trends, et cetera. And my kind of thesis on Solana came from the bear market in like 2018, 19. Best time to be doing R&D is during a bear market. And so I started to track the Ethereum ecosystem, build some Solidity applications, was getting familiar with that. And then what dawned on me was like, wow, this is such a huge leap in computer science. You can have these kind of permissionless applications just execute code, and it can be verified in a uncoercible way. Like, that was just such a huge leap, and I commend Ethereum for that. What I was seeing though with Solana was they are taking a completely different approach to scaling a blockchain, and also managing spam and making it cheap, et cetera, et cetera. And so what I was looking at with Solana was, okay, Ethereum's design, which is not bad. I'm not saying this was a terrible idea. The design from a developer's perspective is, anytime I build a Solidity application, I have to kind of optimize the code at like a per line of code level, because it costs gas to execute all this kind of stuff. And that then leads to like a second order effect of, well, developers are likely going to build applications that aren't meant to be interacted with very frequently, because it's a non-deterministic fee. It's not deterministic in terms of how long it'll take for the transaction to settle, et cetera, et cetera. Solana thought about this very differently. They were like, what if we made it dirt cheap and super fast? And also we can do this by parallelizing transactions, where when certain aspects of the state don't need to affect each other, they can be transacted in parallel. This to me was like a movie I'd seen before in tech previously. This concept of parallelizing, compute or tasks is not new. We can go back to, processors when they started to add SIMD, which is single instruction multiple data set, right? Instead of just doing one thing, you can do 4 of them. It's the same concept. And so my view was really, hey, if there's going to be an alternative to the approach that Ethereum has taken with building, call them smart contracts on Solana, they just call them programs, it's probably going to look something like this. And furthermore, when you now enable developers to not worry about how long is this going to take, how much is it going to cost, the spectrum of applications that they can build widens dramatically. And so my view was, hey, for the things that Ethereum is really good at, they'll probably just kind of own that. But for this other, massive set of applications that developers will inevitably just try out new and interesting things, this feels like a platform that would enable them to do that. And what we've seen, irrespective of the price, what we've seen in Solana's, kind of technological arc is, yes, they've had challenges. Pretty much every open source project has, right? They've resolved all of those issues, particularly around reliability. But more importantly, the things that they've now added, things like state compression and enabling like the minting of millions of NFTs for, a couple of dollars, it's just not possible anywhere else, at least currently, right? It could happen on a new chain. It could happen with some, changes to some architectures, et cetera. But what's cool about this, from my perspective, is that when you enable developers, and I've seen this open source for a long time, when you enable developers to kind of have full expression of what they can and want to build, you end up with a lot of innovation. And to me, I don't want to say I hate using this analogy because it seems somewhat derogatory, but Ethereum's kind of like Android, right? Like OEMs can utilize this, and it's a mobile operating system and it works or whatever, right? But Solana kind of operates like the iPhone, where Apple controls this kind of vertically integrated state, even though, yes, Solana is open source and all that. The point being that the types of applications that can be built on an iPhone, and people choose to build on iPhone first, even though they have less of a market share, ends up driving a lot of innovation in the mobile space. I see the same sort of thing happening with something like Solana.
Mm-hmm. What's Solana's biggest problem today?
Liquidity. We need more liquidity on chain. I'm serious. Like, look,
is that a function of just not enough people, institutions, funds? Certainly the DeFi ecosystem is thriving. You're seeing DEX volume surpassing Ethereum. Most recently, I've invested in closely kind of monitoring a lot of DeFi protocols, and the functionality and the protocols very much mimic the DeFi ecosystem in Ethereum. So when you say liquidity, can you help us unpack that?
Yeah, I mean, look, Ethereum was first. Ethereum was the best. They have the lion's share of assets available in pools and locked up. I'm not a huge fan of TVL, but people tend to use that as a shelling point for kind of like the value of a DeFi ecosystem. It's just too low on Solana right now, and I think some of that had to do with the fallout from FTX. And a lot of teams got really kind of disenchanted, I would say, given that the price of Solana had dropped significantly, DeFi activity dropped significantly, and that has left a void with respect to liquidity for DeFi on Solana. It has, to your point, picked up. I've been mentioning this on my Twitter. DEX volumes are off the charts. Stablecoin inflows are huge. That's just now happening. And so one kind of key thing that did happen quite literally at like the Pico bottom, it was on, I think, Christmas Day last year. There was a coin that was launched on Solana called Bonk. And, a lot of people look at meme coins or arcade coins and they kind of like, oh, it's no utility, yada, yada. What was really fascinating about this kind of experiment that has gone incredibly well is that Bonk was airdropped to loads of developers in Solana that had been kind of, upset with what had been happening with the Solana ecosystem. Like they plowed all this time and energy and resource into it. And now all of a sudden this scammer, arguably one of the biggest frauds in US history, is being associated with it. It's dragging down, people are leaving, et cetera, et cetera. So what they did was they airdropped all of these, tokens to thousands and thousands and thousands of wallets, and loads of those were developers. And it turns out that those developers are scattered all around the world, where a $10,000 airdrop is really meaningful money for them to continue to persist on building on Solana. And so you had this interesting kind of set of dynamics where Solana hit $8. People were saying it was going to zero, which is obviously why we got long. And furthermore, you had this kind of destitute mindset amongst the developer community that all of a sudden was kind of 180. And since then, Bonk has become kind of integrated into dozens of protocols throughout, I think hundreds, actually. I'm way underestimating this. And not only are they like, integrated within Solana, it actually has become kind of like the culture coin for Solana. And so I've talked about this on other podcast briefly about like, if you wanted to invest in internet culture, like how do you buy a derivatives contract for internet culture? You really can't. Like maybe you could buy stock in Reddit or something, but like you can't really buy internet culture. And so there is this kind of contract that's a derivative of it, which is a lot of these meme coins, et cetera, Bonk is by far the kind of culture coin for Solana. And it's one of the reasons why I think a lot more retail will come to Solana is that Bonk, like, it's integrated everywhere, and you can just kind of like try stuff out for fun. You can get airdropped a little bit of Bonk to just try, swapping or doing something with NFTs or whatever the thing may actually be. And that, coupled with the developers getting this airdrop, has kind of like accelerated, I would say, some of the activity on chain. Because what we're seeing now, of course, with the flows coming in and the story behind why Solana, why should I invest in Solana, et cetera, a lot of it's being driven by the culture of Solana. And I think that was a problem for sure. But right at the bottom, we kind of had this event, and I think that just really changed the trajectory of Solana's course.
Let's play a fun exercise here. So Bonk, I'm looking at Bonk, and it's roughly $175 million fully diluted val. It trades some serious volume, 30 million a day. What do you think outperforms, Solana or Bonk over a 3-6 month period, 1 year period? Like, honest question. Like, would you go long Bonk or would you go long Sol? You could only do one.
Bonk. It's that simple. Yeah. I
really?
mean, look,
really.
So
it probably has a two. If you think it's Sol,
well, I'm trying to figure out.
I think this is like a 2-3 beta Sol.
I'm trying to think if it's basically Dogecoin, if it trades like Dogecoin, which is one thing, or if it trades like punks, which are basically just a higher beta on ETH. So, and those are two very, very different trades, right?
That's correct. Yeah. So the analogy we tend to use for folks on Ethereum is like, there's Ethereum, Chainlink, and Shiba Inu. And then on Solana, there's Sol, Pyth, and Bonk. And Dogecoin is definitely its own beast, right? But if you have something that's actually high beta, I mean, Shiba Inu definitely high beta to ETH, no doubt about it. Certainly was. High beta to Sol would be Bonk. But I think also, like, it's very rare to find a meme coin or a culture coin that is so deeply integrated into the entire ecosystem that it's everywhere. And yes, there's also the unit bias thing, right? There's a reason Shiba Inu took off, because people felt like they were billionaires because they had $40 worth of Shiba Inu, right? Like these kind of like mental gymnastics that people do when they get into crypto. Bonk is obviously capitalizing on that as well. But there's actual, like, I mean, the team that's behind it, I mean, they're everywhere in the Solana ecosystem. And so I would actually argue that they're probably more deeply integrated than any startup that's in Solana at this point. And it's just a culture coin. So, again, this is not financial advice whatsoever, but, I'm
longing like $1 million. I'm going long $1 million bucks a Bonk.
Yeah,
right now.
I mean,
no
I'm a big fan of Bonk. Let's put it this way.
All right, everyone. So we talk a lot about the institutions coming into crypto on Empire. Santi and I are both headed out to London March 18th to 20th for Blockworks' 8th ever Digital Asset Summit, DAS. This is an institutional buttoned up conference that we've hosted since 2019. I like to joke that it is probably the last remaining kind of suit and tie event in crypto. People are still wearing suit and tie. It's pretty funny, but you'll actually hear from a lot of the largest institutions in the world, coming from Standard Charter, FIS, JP Morgan, Framework folks coming out, Wintermute, Van Eck, Goldman Sachs. There are a couple big themes of this conference. 1, Bitcoin catalysts, the halving and the spot ETF. 2, a view from the buy side. 3, RWA's tokenization and stablecoins. 4, global regulatory frameworks. 5, institutional infrastructure, including banking and payments. And 6, the macro case for crypto. If you have anything to do with the institutional side of crypto, you have to be there. Santi and I got your back. We hooked you up with a 20% off code. It is Empire20. There is a little competition running internally at Blockworks to see who can drive the most number of tickets. So help Santi and I out. Register with our code and you get 20% off. That is Empire20. This episode is brought to you by Toku. Toku makes implementing global token compensation and incentive awards simple. With Toku, you get unmatched tax and legal support to grant and administer your global team's tokens. From easy-to-use token grant award templates through token vesting to managing tax withholdings, Toku understands every grant structure. Token purchase agreements, restricted token awards, restricted token units, token options, token appreciation rights, and even phantom tokens. For legal, finance, and HR teams, it is a huge, complex task to have to comply with global regulations around compensating people with tokens, not to mention the payroll, tax obligations, tax reporting in every country that you employ someone. It is difficult, time-consuming, manual, and costly, and it is drawing more and more attention from regulators and governments. Toku makes this simple for leading teams across the space. Protocol Labs, DYDX Foundation, Mina Foundation, Hedera, Gnosis, Safe, Gitcoin, and a lot more. Reach out to Toku at toku.com/empire or click the link in the description.
Yeah, I think I want to ask two questions. One is, I mean, you certainly, I saw you being very vocal about Solana at the bottom. I also felt that at $8 publicly, I said in this pod that it was probably a good time to buy, and it was, when everyone is sort of dancing on the grave and saying that Solana's going to die, is probably the moment where you want to counter trade that. Obviously, it's had a huge run up. How do you manage risk? I mean, it's a broader discussion on managing risk in a liquid venture asset class, but along the way, have you taken profits? It's been a fantastic year. If you were long some of these assets early on, especially Sol, ETH. I mean, Sol is sitting at what now? $54, $50?
Yeah, it's a great question. I mean, because I think some LPs and other funds have learned the hard lessons of a long only crypto hedge fund where you're up, 10,000%, and then you see 80-90% of it get drawn down. That's just unacceptable at Asymmetric. We are on the hedge fund side. We're a hedge fund, right? So our job is to generate returns, and so there's a couple of things that we do at Asymmetric that, I mean, it's not rocket science, but I don't know a lot of other funds that are doing these types of things. It's very common in traditional finance. So, for example, when Solana hit $8, we got max long. I should say max long. We don't use any leverage. It's actually hard coded into our limited partner agreements. We don't use anything above 1x notional. But what we can do is when you see, Solana trading $8, and we know that funds were having to raise cash because investors were redeeming because 2022 was such a shitty year. We saw that as a huge buying opportunity, but not just on the spot asset. We also purchased what's called a risk reversal. If you guys have ever traded options, so we sold a put at $7 in sort of $8 or $7 or $8 put. And then we bought a call spread in Solana 20 by 25. So you're 5 points wide with pretty reasonable size. And dealers will sell you that because they're like, this is a 3x from here. Like, how is, there's no way, or I don't want to say there's no way. Obviously, there's a way. It's a distribution of outcomes, but they're happy to do that kind of stuff. And so one of the ways we get extra juice from just being, say, long Solana is the way that we express things through options and derivatives. And so we actually kind of nailed that call spread because it went directly to $25. We took profits in our spot as well because we're traders, right? We understand that on the one hand, we can have a philosophical view and a technological view, which I do. That's why we're invested in a bunch of startups in the ecosystem. But we're also traders and go, hey, this thing just tripled, probably should take some profits. And if it keeps running, okay, but this is pretty hot after it just got murdered for call it 14 straight months or 13 straight months. So from our perspective, we manage risk in a way that says, like, we never go above 1x leverage. Where do we take profits? We have levels identified in advance, and that's where we pinned that call spread. Was like, we think this thing goes to 25. Now, so then market kind of traded sideways. Basically, Solana was in this 20 by 25 range for months. It kind of dipped down and bounced back up, and it's finally broken out. And so now I don't want to say we wouldn't be taking profits or whatever. Like, we definitely, Solana's move has increased the implied volatility of the options markets for Solana dramatically. And so we like to sell vol when it's really expensive. So you can imagine that we're selling, puts and calls against some of the spot, generate some additional carry. And this protects us in the sense that if, Solana pulls back, we maybe got puts that we can kind of lock in the profit there. Or if we're selling, say, I don't know, out of the money calls and we get called to it, we're probably taking profits at that level anyway. And so, again, this isn't really like rocket science and TradFi. This is just, I don't think it's a common way that a lot of the liquid hedge funds in crypto operate, because most of them are just long only, or they lack kind of the capacity or knowledge for how to actually hedge your book or generate additional carry off of options and derivatives.
Yeah. A lot of it has been inefficient pricing and who can sell you these things. Has it gotten better or worse? Because a lot of the market makers are gone and they, no longer exist. And even when they were around, pricing was certainly relative to traditional finance, just really wide and inefficient. So are you finding the ability to do that in size in this market?
Yeah, great question. And man, do I have some stories. I will not name names because that is not my style. I know that you guys want this as a media company, but I can't name names. I'll give you an example. So there are some dealers that we trade with that are publicly traded, like Galaxy, right? Great team. Love the team over there. They're by the book, very little credit risk with someone like Galaxy, knocking on wood as I say that. We like trading with Galaxy. They're a little wider on pricing in some scenarios. In other cases, they're great, right? If they have an axe, which for folks that may not be familiar with that phrase, when a dealer is axed, it means an axe head points one direction or the other. So they're either too long or too short when they need to stay neutral. So they give really good pricing when they have an axe. Some dealers are trade a lot of size, but are I would say not exactly what you would think who they are, right? Okay, so I'll give you an example. In June of this year, we had a view inside Asymmetric that there's going to be news on Ripple some point during the summer. We didn't know when, we just knew it was coming. Ripple was trading about, 45, 50 cents, somewhere in that range. We said, all right, let's go ping our dealers and see who will sell us really cheap, wing options, like wing call options, way out of the money options, and at what price, and what size. And so we found a dealer that we were working with. We've done some trades with them in the past, Bitcoin and Ethereum. And I said, hey, we're interested in buying, August 7th, September 7th calls in call it between 70 and 75 cent range. So huge move from 50 cents. What you guys make us an offer on this? And they said, sure, let's sell them to us for a penny. And I said, I'll take as much as you'll sell me. And they sold us about 15 million notional of XRP. So it only cost us about, $185,000, which is not a trivial amount of money. But suffice it to say, when the Ripple news came out and it traded above 90 cents, we were very happy at Asymmetric. But guess what happened with the dealer? They made us a price when we tried to get out of the trade that basically was below the price we paid for it. So yeah, this shit's still happening. Yep, it's definitely still happening. And so, lesson learned, never trade with them again, right? Very simple. And again, I'm not naming names, not going to bash the dealer. They are very well known, but that's just bullshit. And you effectively ruin your relationship and your reputation when you do that type of stuff. On the other hand, there are really good dealers out there. It is actually a shame that Genesis Trading isn't around anymore, because the trading arm was really, really good.
Yeah.
Really good. And that is and I think there's rumors of a team that team is ending up someplace else, and thank God, because they were very good. And so there are other dealers that are doing the right stuff that are will make you a price. They're not going to pull this this bullshit that we dealt with. And the more that we can kind of flush those types of actors out of the space, I think better overall, because I'm telling you right now, an institutional fund much bigger than me that comes from TradFi into crypto and has that happen, they're just not going to take this space seriously, because that kind of stuff would never happen in TradFi, right?
I'm thinking of the Big Short scene where they're being quoted CDS once the price, like, prices start falling. They're like, wait a minute, why isn't it updated? It's actually going down. But
yes.
Yeah, like inefficient market. And what happens in that scenario? Like, do you contest the price? I mean, is there any recourse? Like, can you go find another buy? Like, I'm just kind of curious. Like,
so this is where it gets a little tricky, right? So we could go to one of our dealers and say, hey, like, we, basically, if we're long calls from 70 cents and Ripple's trading 90 cents, we say we want to short Ripple at 90 cents and basically lock in the delta, right? So, if the calls go up in value and at expiry they're trading whatever, like, we make that money. If Ripple goes back down, well, we're shorted. So we basically locked in the delta. The problem with that is very few dealers will let you short that much Ripple, right? Because then you got to post all this additional collateral. Well, if my collateral's tied up someplace else, right? Like, it just becomes a major pain in the ass. And so at the time, we were unable to kind of thread the needle on that, which was, as you can imagine, a huge bummer.
I'm doing the math on how much profit you would have made if these guys were actually legitimate.
Yeah, it was a lot.
I'll buy you coffee, Joe, when I see you in person.
Yeah, thank you. So yeah, you could do something like that, but then there's the collateral issue. You could go to another dealer that would say, hey, where can you sell these options to me? But if I'm short the option, I got to post initial margin. It's a mess. And so the ideal scenario is the dealer honors the price and does the right thing. In this scenario, they did not. And so, not much you can do except chalk it up to the game and move on.
How concentrated is your book at any given time? Talking about just overall risk.
Well, I'm looking at it right now.
It's just Bonk and Sol, Santi.
Mine is now too, but it's okay.
Yeah.
I mean, so, look, like, we got really long, obviously, in October. So we tend to run a relatively low net most times, but we're running a pretty high net right now just because we think the market has shifted.
What does that mean, Joe? To run a high or low net?
So basically, like your net leverage in the system, right? So like, how much literal, like, cash do you have relative to what's being invested, right? So if you're running like a 50 net, you're 50% cash, 50% kind of invested, right? And one of the reasons we like to run a low net is we run a lot of option strategies and structures that enable us to be very capital efficient. And when we're right, they are worth a lot of money. And so you actually can still retain a significant amount of your cash on hand, as opposed to just like, YOLOing into a bunch of spot tokens and kind of crossing your fingers, which is something we would never do. So, it's very, to answer your question, Santi, it's very market dependent, right? So we have a pretty high concentration in Sol right now. We do have some exposure to Ethereum and Bitcoin. They are smaller, as you can imagine. I think we actually are the only fund that actually owns Bonk.
Joe, what would you say to folks who are on the institutional side and feel like they've missed the entry for Solana?
That's another really good question. I mean, if you're trying to, well, I guess let me back up. It's probably, what's your time horizon, which is like the kind of canned response to that, but it's really true, right? If you think Solana can go to 1,000 and it's trading 50, you just hand over fist buy, right? You don't think about it. If you're looking for like something a bit more short term, then I think you've got to be a little bit more diligent as to how you would kind of enter into the market. I run a Telegram trading kind of channel, and I've been doing it for years. Thousands of people subscribe to it, and it's a lot of fun because it's just kind of my stream of consciousness in there. But people will always ask in the chat room, should I buy this here? And I'm like, only you can answer that question, right? Like, it's like, I don't know your personal finances. I don't know your portfolio. I don't know what your risk tolerance is. And so, do I think Solana is going significantly higher longer term? I hope it's clear that the answer is yes. Do I think you should mortgage your house and buy all this Solana right now? Probably not, right? Like, let's see what happens. But I do think the train is left on this.
Probabilistically, and certainly reflexivity is a big thing in markets and certainly in crypto. Would you say that Sol has a greater probability of hitting 100 than it does 20 over the next 90 days?
Without a doubt. I would say super high probability it goes higher than it does go back to 20. And in fact, it's funny you mentioned 20 because I mentioned this actually, I think in my trader chat a couple months ago, is that, Solana has been kind of trading in this 20 by 25 range for months. And so once it breaks out, what people will look at is that that's kind of like generational support almost, if you will. And so I don't think, look, anything can happen, right? Like, this is crypto, but I think it would be a steal if it got back into the mid 20s. Again, I'm not kind of like a predictor of levels of where you should be buying from, but if you feel like it's run too fast, too high, too fast, maybe you just set some bids at reasonable levels, 10, 20, 30% lower, and then just like set it and forget it, right? If you're actively trading it like I am, you got to be a little bit more diligent.
I was just, I've been thinking a lot about just, of course, we're talking about flows and stable, like a lot of things, in the grand scheme of things, not a lot of capital is required to double a lot of these assets or more. But what weighs on me relative to perhaps other cycles is sort of this whole macro. But, to your point, rates are where they are. I'm not a macro expert, I think, but you can't overlook that, I think, now. Where the market, NASDAQ, like all of that is, being tested. And I am curious how you factor all of that in, and does it compute into what you're seeing, or are you just saying, hey, look, we're constantly monitoring flows. If we see a deviation from that, we'll act quickly, hope to act faster than others. Maybe I'm just trying to understand how you compute macro into all of your thinking and allocation.
Yeah, great question. And absolutely, we factor macro in. In fact, if you read any of our market updates, we have a dedicated section to macro, and we've had a number of our actual LPs, and anybody can subscribe to this. Go to subscribe.asymmetric financial, whatever, if you want to subscribe to the monthly newsletter that we put out. We've had LPs tell us and other investors, this is the best macro stuff we've seen like ever from a fund that we're invested in, and we're not a macro fund. But the difference is that crypto is part of macro, whether you like it or not, right? You saw this in 22. Every risk asset, including bonds, got absolutely decimated. Crypto is furthest out on the risk curve, so guess what's going to get hurt the most? Crypto, right? We knew this. I don't want to say we knew this. We forecasted this in 22, and you can read it all the way back to when we started publishing our market updates in August, that we were bearish the market. We just did not see a bottom in yet for risk, given the tightening cycle and other kind of macroeconomic indicators that we had been tracking. And if you do go back to I think the September article, we predicted in this year that we think rates will top between 5 and 6%. And that's a relatively wide range, but we're kind of in the middle of that, closer towards the 5.25, 5.5. That has absolutely affected our investment decision making as it relates to crypto. So there's a couple of ways that we kind of put on trades, if you will, at Asymmetric, and there's kind of three buckets. One is fundamentals. So we believe decentralized storage is going to be a requirement for Web3 applications. So we should go find the best, decentralized storage. So whether it's Filecoin, Arweave, or some other thing, right? The other one is kind of event or narrative driven. So the canonical example I use here is in December of last year, we had a view that the kind of liquid staking narrative would really pick up steam as we head into the Chappelle upgrade for Ethereum. Well, who's the biggest staker and who has a liquid token, Lido, right? So we did that trade, but we got out of it. So that's an event-driven, idiosyncratic. And the third one that we look at is macro. And the way we tend to express a lot of our macro views is primarily through Bitcoin and Ethereum to some extent. And it has a lot to do with our ability to structure things in options markets in ways that enable us to express that view. So I'll give you an example. When the banking crisis happened, the regional bank acute issues, as the Fed likes to call it, happened in March. We actually wrote about this like a month and a half prior. We were basically in our macro section. We had said, the Fed keeps saying bank reserves are strong, bank reserves are strong, bank reserves are strong. But what they don't qualify is that the distribution of those reserves across banks is not equal. So the regional banks had major issues with regards to reserves, whereas the GSIBs, the massive banks, did not. And so our view was there's a tail risk here with regional banks because of the unequal distribution of reserves amongst these banks. Well, what does that mean? Well, if there's a bank run or there's bank collapsing or there's issues with banks, what do people then go do? They go buy gold. This has been a natural thing that has happened for forever, basically, since banks have been around. And we said, all right, well, gold is a flight to quality asset. Well, how do we do that digitally? You buy Bitcoin, right? And so when the kind of banking crisis, if you will, happened with SVB, that weekend we got massively long Bitcoin spot, as well as a lot of upside call spread and certain structures that enabled us to capitalize on a significant move in Bitcoin. And even though the banking thing it's not macro like interest rates, it is related to macro. And given that we saw this flight to quality narrative going to pick up steam with respect to the stress in the regional banks, we wanted to be long Bitcoin in that regard, but then we didn't want to just be long Bitcoin spot. We wanted to find the best way of expressing that view. And it turned out that vols were dirt cheap around that time, and we could buy really cheap upside. And naturally, the Bitcoin exploded after that.
What are some other, you mentioned fundamental driven trades like Filecoin or Arweave? Folks will need digital storage. That's a trade there. Another one is like an event driven trade, something like Lido. What are some other either event driven trades or fundamental trades that you guys are excited about right now?
Yeah, so I'm definitely talking my book here on the VC side.
I'm asking you to do it. That's all good.
We do think, we do think cross-chain messaging and interoperability is a pretty important piece of kind of Web3 infrastructure. We did the first round of funding with Variant and a handful of others into Hyperlane, which is kind of like a layer zero competitor, if you will, from like a comp perspective. Obviously, we think it's superior, but we think that piece is going to be huge. And part of this is like, yes, the bridging and the interop is kind of a pain in the tuchus now, but it will be hopefully easier going forward. But there's another aspect that I don't think a lot of folks, when they're looking at like cross-chain messaging or the interop, are focusing on, which is in software development for decades, we've had this concept of message passing, arbitrary message passing through message bus or RPC, et cetera. And I don't think that design space has been really well explored as it relates to Web3, because the kind of canonical interop is bridging. Well, what happens when you start passing arbitrary messages of information or metadata or some other thing that isn't invented yet in crypto? You're going to need deep infrastructure roots to enable that to happen. Hyperlane can do that. And I'm not suggesting the other ones cannot. I'm just focused on the one that I'm invested in, of course. But I think that is a huge opportunity on the fundamentals side that hasn't really been primarily explored. So that's another one on the fundamentals. As it relates to event-driven, we did actually very quickly trade Blur when it first came out. You kind of saw, like, we are big fans of Tensor. I missed actually investing in them because I had a baby on Christmas Day last year and was like out of the office. But Tensor on Solana is like, I mean, if you do any type of NFT trading on Ethereum, you just have to go look at this app. It is mind blowing how good it is. And our view was kind of like, well, Tensor doesn't have a token. They're still relatively new, but they have an unbelievable kind of carve out with what a trading product should look like for NFTs and collectibles. And so when Blur came around and they did this, the airdrop, token launch, et cetera, we just thought that narrative would pick up steam with Ethereum traders, and it did. Well, we know what's happened to the price since then, but that's why we got in and out of the trade in, I think, less than like a week and a half, right?
What about going back to your Solana thesis, Joe? You mentioned parallel processing. How does the fact that there's folks bringing parallel processing to ETH, like Monad's doing that. You have Eclipse, right, announced their general purpose SVM kind of L2 on ETH. How does that impact your Sol thesis?
Yeah, great question. And this gets back to kind of my open source roots, if you will. I think I was on the podcast with the Lightspeed podcast, and they asked me about, Eclipse, for example. And I am all for the SVM being forked and put everywhere. And the reason that this is so you see me smiling is that this has happened over and over and over again in open source. When a kind of core technology starts to get forked or integrated or implemented in areas that hasn't happened yet, that core underlying technology has a very strong Lindy effect being built behind it. And the reason is you now have something like Eclipse. They have a dependency on the SVM. That means the SVM has to exist and persist in order for their project to be successful. So, the move lane chains, Aptos and Sui, they're using parallelization, right? Great. All you're doing is validating the thesis behind Solana. And so I think the more we see SVM get integrated in other areas, the team at Monad, what they're doing is awesome. We're big supporters of that as well. All this, I don't want to say the value of the token accrues back to Solana, but the intellectual value ends up flowing back to who did it first, which was Solana. And I think that is an extremely powerful statement to be made to new investors that are coming into the space to say, hey, look, from a first principles perspective, Solana did something fundamentally different that people said would not work. It's working. And by the way, it's now being, kind of modeled with these new move lang chains. It's being modeled with Monad. It's being forked into Eclipse. It's being forked into actually the Pyth network. So if you guys are familiar with Pyth, it's a decentralized pricing oracle, right? So their 1.0 version just used Solana. Well, guess what they're doing? Their 2.0 version is an application-specific chain built on Solana. The guy, the founder of Maker, what is he using for his new project? Solana, right? It's a fork of Solana. So this is all. I'm
really excited about how the SVM being open source kind of lends itself to these new ideas that you can utilize the SVM in a bunch of different ways, basically.
Exactly.
But you're saying that value all ends up not maybe directly flowing back to Sol, but almost indirectly because it's where it all came from.
Exactly. So there's precedence of this in software design. So if you look at the Linux kernel, how many flavors of Linux are there?
Yeah,
I don't know, dozens at this point. Or the JVM, the Java Virtual Machine, created by Sun Microsystems. The JVM is literally everywhere. Like your TVs, your micro, it is pervasive. And there are multiple kind of versions, if you will, of the JVM and the JDK itself, the Java Development Kit. Did all of that money flow back to Sun? No, but what it does is it supplants the JVM as this kind of canonical virtual machine for software development, right? So if the SVM can become the canonical virtual machine for, say, parallelized compute in Web3 networks, I am all for that because the success of the JVM has spawned, multi-trillion dollars worth of value for, so call it Web 1, Web 2, and just software in general. Would love to see a fraction of that happen because the SVM gets forked and integrated into myriad projects.
When you think about the continued success of Solana, how do you think about the success of other L1s or L2s in that context, meaning, Ethereum, some of the L2s, some of the other competing L1s, you mentioned Aptos, Sui, some of the others. How do you envision kind of this world? Does Solana continue to suck and drive more market share, intellectual capital, or do you see thriving ecosystems and just more connectivity among them?
Oh man, the $1 trillion question that people love to ask me, because I definitely have a non-consensus view here. No surprise. So let me kind of like caveat this with saying that I don't, I'm not a Ethereum hater. I'm actually very pro Ethereum, especially on the technology side and some of the stuff that they're attempting to do with proto-dank sharding, et cetera. Like, I mean, I'm just like wowed if they can pull this kind of stuff off. The Chappelle upgrade was probably one of the most incredible software upgrades in history. So there's a lot of good stuff that I am pro Ethereum. Now, let me talk about why I don't think L2s will work. So I've been kind of talking about this for, 18, 20 months or so, that the reason it's called an L2 is now you have two problems. It's probably more than that. But the reason that I'm suggesting this is that if you take it from a developer's perspective, when you start to introduce this new, like, literal layer of software that you are utilizing, you now have an upstream dependency on the L1. Well, what happens when, like, Ethereum, changes the underlying source code or, upgrades or whatever? Well, now all these L2s, in theory, they should just be able to utilize it. And again, I'm kind of talking loosely because I'm not an L2 developer or author, but I do know that when you're building software, if you have an upstream dependency on something, you have to maintain that dependency, and it can become cumbersome and exhausting, right? That's one aspect. The second aspect is how many L2s are there, and which L2 do you choose? And then even within an L2, like Arbitrum has two chains, right? So which one do you pick out of that? And now we've got L3s. From a developer's perspective, you can kind of get into this analysis paralysis almost, where you're like, I have too many choices when I'm just trying to build an application, or wait, I need to now support all of these other L2s, right? Now let's talk about the user experience side. On the UX side, which L2 am I on? Which chain am I on? Do I have the token? Do I have to bridge something? Do I have the right token? Do I need a token? Can I just use Ethereum? Like, there's all this kind of stuff. And by the way, UX can totally be solved for. That's a solvable problem, but it still underscores the issue that I have right now with L2s, is that from a UX perspective, and by the way, I use L2, like, again, like I know this at least from my own experience, which is certainly anecdotal, but it is non-trivial to just, especially again, like I'm going back to Solana, like if you just go use something, like Drift Protocol and you want to trade perps, it's just like a normal exchange with like a transaction approval. It's so normal. It just feels normal. Whereas if I'm doing something on, this aggregator versus that one, how do I set a limit order? Why is it like timing out? I just paid all this ETH and it didn't work. Like, it just, there's a lot of additional cruft associated with it from a UX perspective, which again can be solved for, but isn't currently today. The third thing, and I think this is something that kind of dawned on me, and I know I will get absolutely flamed for this in my Twitter, but it dawned on me when I was looking at like the rise in L2 activity and then like the drop in the cost of gas. I was like, wait a second, are L2s actually now going to cannibalize a lot of the activity on the L1? Which I thought the narrative was more activity on the L1 actually makes it deflationary, so number go up. And I'm looking at this going like, wait a second, if L2s are actually the scaling solution and all the activity or the majority of the activity happens on L2s, and a lot of that doesn't settle back to the L1, like from a one-to-one perspective, what happens to the deflationary narrative associated with the L1? And, again, this is like a relatively new thought that I'm sure I'm wrong on in some capacity, but it just dawned on me that, hey, if the scaling solution for Ethereum is to abstract away to something else that isn't necessarily going to impact, like, say, the amount of settlement that will happen on the L1, doesn't that have an impact on its deflationary outcome? I think the answer is yes. And the last thing I'll mention is I do think L2s will do well, right? Like, we're long ETH, we're long Arbitrum. Like, we like Arbitrum as like a beta to ETH. We could sell that trade in an hour. Like, the point that I'm getting to is that if you're investing in L2s on the token side, I think they will actually do better than Ethereum. You've got unit bias, you've got more, activity happening, you've got more potential narratives forming around these particular L2s, et cetera, et cetera. So I do think that they will actually outperform ETH on a relative basis, call it over the course of the next few years. But the last thing I'll mention is that there's a ton of VC money behind this. And I kind of wrote about this in the market update that they're going to will this into existence. And so the notion that Ethereum is going away, the notion that L2s are going away is nonsense. And I am very aware of that because the amount of money that will muscle this stuff into existence is massive. And so the irony here is that a lot of these same VCs that are kind of muscling money into the Ethereum ecosystem, and rightfully so, are massively underweight Solana. And I've heard from them, they're saying I got to get up to speed. Who are some companies I need to talk to? What are the projects? Can you get my research on with so-and-so, yada, yada, yada. And so I think as kind of a final thought is that, do I think L2s work long-term? No. I think there has to be some combination of, developer heuristics and workflow coupled with a UX improvement and some way that it actually helps benefit the L1 on the in terms of the deflationary narrative. But I do see a path for this stuff persisting for quite some time, whether it's the insane amount of developer activity in the Ethereum ecosystem and or the amount of VC capital that's flowing into the space.
Is that thesis predicated on this idea that it needs to be deflationary for it to work?
No, I'm just saying there has been a very strong narrative, I would argue, from multiple communities, not just the Ethereum community, that hey, now that we're a proof of stake with the activity on the chain going up, it becomes deflationary, which is amazing.
Sure.
It requires activity on the chain. And if you look at the activity just over the course of the past year, you basically had a spike with Pepe coin, and you've had a couple of idiosyncratic things here and there, but it's been trending lower and to the right. It's not really what you want to see if the narrative is, hey, more activity on the L1, it's going to lead to this deflationary outcome.
Yeah, no, certainly. I think the more important nuance thing is, what is the relationship between increased activity in L2 and how much of that is settling back to the L1, and what does that ultimately translate into? Because I think the counter argument to that is, look, you believe that we're so early, the use cases are vast, enabled by an L2, that if you believe that the user activity and volume is going to, do some sort of order of magnitude or two increase across these L2s, that will, again, based on the ratio that you're assuming, will benefit the L1. But it's all agree on the margin, right?
And that's exactly when I was talking with one of my colleagues, kind of sussing out my theory here. My kind of response was, it would require orders of magnitude more activity in L2s, which could certainly happen with mass consumer adoption of Web3 through Ethereum /L2s. It could absolutely happen. The current forecast that I see has a lot of friction in front of it. So, for example, if you look at the crazy amount of activity that's happened in Solana over the past month plus, imagine that kind of on a relative basis for L2s. I think that genuinely benefits the L1. We're just there's the UX challenges and the developer workflow as well.
Yeah. To be fair, one of the more eye-opening experiences I've had in Solana was Drip. I spoke with them and I started using it, and they said, look, even if we were to, and for context, Drip is that program you can just, every day they're issuing free NFTs, and you, in your opening statement on your Solana thesis, you said, minting on a batch millions of NFTs at once is kind of very unique to Solana. And the Drip team mentioned this, and they said, listen, even if we were to deploy on an L2, it would have cost us, it wouldn't have been viable for us as a startup to deploy even in an L2 in Ethereum. So we had to use Solana. And so I think that was very unique. And Drip, again, is very nice. I think from a user perspective, getting these free NFTs, which have some value, is pretty cool. And so some of the consumer applications today are very unique to Solana that aren't, even an L2 would have been possible. I
just
guess.
quickly on that point,
Yeah, go ahead.
just really quick on that point, this was something that I talked about with a lot of brand managers back in the 21 cycle that were like, hey, we need to, I used to work in the advertising industry in New York at an agency and was CTO there. So I have a little bit of this kind of creative communications background. And a lot of these folks were like, I gotta do an NFT thing. I don't know, like, what do I gotta do? And I was like, well, what's your budget? And they would tell me their budget, and I'm like, yeah. The problem is that like you can't do that for your audience size on Ethereum. And they're like, but yeah, but that's where like CryptoPunks and Bored Apes and all this stuff. This is where I'm like, yes, that is correct. But what you're talking about is, like your cohort of consumers is in the tens of millions, and so that could be, I don't know, 10 million or 200 million just to mint the NFTs. Like, we don't know what the price will be, right? And so a lot of this, my responses to them were like, you should look at something else, maybe Solana, because you could actually do what you're describing. This was before they created the CNFT or state compression associated with NFTs, where it's even cheaper than it was before. And so
even cheaper.
One of the things about Drip specifically is that it is one of these instances of, when I talked about that spectrum of applications expanding, this is a prime example of it. These guys they're brilliant. I love the team, very smart, killer founders, have this vision for this, creator content-y type, everyday business that is utilizing NFTs, not in the way that, say, a Bored Ape or a CryptoPunks is being utilized. They're utilizing it as content. And that is a huge unlock, which is, to your point, something that's basically only possible currently on Solana.
Yeah. When people ask me why Solana, it's like it really enables unique consumer applications, and the fee market is just a very elegant design, and that talks to, like, perhaps a third point is the team, the DNA of the team, and Anatoly and everyone else is, they've just probably the best team that has taken at times very harsh criticism and use that to their advantage to improve a protocol, because you're constantly in open source, to your point, improving it. And I think that's a winning. If Solana wins, like, I mean, it's already winning, but if, like, I think that's their main advantage is that they're just built a bit different. What could derail Solana at this point? And then in the last couple of minutes, I want to get your take on perhaps certain applications that you're excited about, or sectors that need more funding in the ecosystem that you have a venture arm as well that you're looking out for.
Yeah. So first question is, what could derail Solana? I think this is the case for probably any L1, which is an outage, right? Some 0-day style exploit of a chain. I don't know. Barring that, I think that's implied with basically anything you invested in Web3 at this point. One of the challenges I think that Solana could potentially run into is, and this is probably a bit minor from my perspective, but they have been onboarding loads of developers, and I've talked about this in the past, where like my kind of brain dead investment thesis as like an angel investor or whatever is just follow developers where they're going, and there's probably value there. They are doing an amazing job of that. But I do think that there's an opportunity to improve it. One of the things that, like you said, Anatoly is a great friend. He's an LP in the fund. He's awesome. He's brilliant. He's gigabrain, right? So he's there's shit that he says that I'm like, I don't even know. Like, I'm pretty smart, but like, this is beyond my pay grade. There is value in that, right? That kind of like pushing to the extremes of what we want to do with distributed systems and a global state machine that's running at the speed of light, like all that stuff. He should be focused on that. There's other things that can be done that's blocking and tackling that makes it easier for developers to build, integrate, deploy, etc., monitor, secure, all the stuff that you see in Web 2 and cloud. We need more of that. And so there's an opportunity, I think, for if other chains, for example, do a better job of the developer go-to-market to kind of leapfrog. To be super clear, I do think, and it's, if you see like the outcome from like their hackathons and whatnot, like they're doing a great job on developer go-to-market. But I always want them to do more, because the more developer mindshare that you can get, and especially showcasing some of these apps like Drip, for example, it opens the minds of what folks thought was possible within Web3, and they can actually do it, especially if you're providing like the tools and best practices and patterns, et cetera. And so it's a minor point because I think they're doing a good job, but it is a potential area of weakness. In regards to some of the apps that I'm
I guess
excited
on
sure.
that point, maybe this is a point. Does the fact that some projects are not open source concern you? I mean, I've invested in this company called Sec3 with Tolly, and it's actually one of my largest checks because I think they're focused on improving security and auditing for teams, and specifically focused on Solana. And again, some teams are not open source. A lot of them are not, I think, still. Actually, very few are open source in Solana ecosystem. So I'm curious, like, does that concern you at all?
So, Anatol and I both pound the table on this on Twitter all the time. There is something that I think rightfully scares entrepreneurs about releasing their code for free, because they think anybody can just take it and clone it, and then how are they going to capture any value? And I'm like, this is the open source business model. It's really fucking hard. I did it before tokens. It's hard. It's really hard. So you have to build something that people want to use and also, integrate, interoperate with. And so I am the optimal goal would be 100% of all Solana programs are open source. That's never going to happen. Should we have more of that? Absolutely. It doesn't concern me to the extent that, more Solidity programs or contracts are open source than Solana, which is true. That's a problem for the ecosystem. I think it's a maturity step that will happen with the entrepreneurs and developers in the space. And by the way, Armani Ferrante of Backpack and Coral, that team, he gets it. I've had conversations with him, and like open sourcing and understanding the power of open source and how it is basically a free distribution channel for your software is unbelievably powerful. The question is, how do I make money? How do I generate, income as a business around this? And there are, some tactics I've talked with some of these founders about, because I'm an advisor to a lot of them on this. And so there's, you can charge hosting, like on the Web2 world, it's hosting, extensions, enterprise, yada, yada, yada. What are those things like in Web3? Well, we're kind of yet to see, but I bet building a killer application on top of it where no one can build it better than you is probably one of them. I mean, by the way, there's a reason that Elon Musk open sourced all of Tesla's IP. He just created a market of EVs that he dominates, right? So yes, you're not Elon Musk, but the same principle applies. You start to distribute your open source code, you're creating a market where your app is the best.
So Joe, I mean, this has been a fantastic episode. You're a great thinker. I don't know if you want to finish off in terms of what's your outlook for the ecosystem, things that you're really excited about, both on the venture and liquid side, and maybe use cases that may emerge this cycle. But up to you.
Yeah. So sure. So in Solana, I think there's a lot of amazing projects. So Jito is lights out. Liquid staking. They're creating a decentralized staking pool operator called StakeNet. I'm probably butchering that. Sorry, Lucas and team. Jito is awesome. Big fan of that. I think there's a kind of a lesser known, I think, protocol called Goose FX that does some really interesting single side liquidity staking. They've got a pretty novel approach to this where it's different than what you would get in Uniswap v3.
Joe, does it sound? It sounds like. Sorry to interrupt there, but it sounds like we're basically taking all of the lessons of what happened on DeFi on ETH of the last 5-6 years, or really, I guess, just last 3-4 years, and building what feels like I've played around with some of the Margin Fi, Orca, Jupiter, what Ellipsis is building with Phoenix. Like these feel like almost cleaner, smoother products, but it also feels like we've had 3 to 5 years of lessons learned. Do you see a DeFi evolving in the similar way that DeFi and ETH evolved, or different?
Yeah, it's a great question. I was actually going to mention Jupiter. The number one app I send people to get started with Solana is Jupiter. I mean, I have guys that are like crypto, just idiots that use Jupiter and they're like, this is an amazing product. I'm like, exactly. That's what it's supposed to feel like, right? The thing I will mention is that, yes, I do think, yes, there's DeFi on Ethereum, DeFi on Solana. Great. The products on DeFi on Solana are, in most cases, I have found smoother, easier to work with in general. This does not mean that Solana DeFi is just a copy and paste of what is on Ethereum. In fact, one of the hackathon winners, and I'm drawing a blank on their name, which is shameful, they're creating these kind of composable order books. Like, I don't even know if this is possible in TradFi. Like, they're just taking the concept of order books and making them composable in ways that I don't fully understand yet the value, which is why I need to meet the team. But like, where are you seeing that anywhere? And I'm not seeing that anywhere. And so again, this kind of underscores what's only possible on Solana, as well as when you give developers free reign, massive spectrum to be building cool stuff on, you end up with stuff like this. Maybe it doesn't go anywhere, but the idea that that type of innovation is even possible is just makes me extremely bullish on what's happening on Solana long term.
Joe, like Santi said, man, great conversation. Really appreciate it. Have a feeling this won't be the last time you're on Empire. So thanks again, man. Enjoyed it.
Yeah, my pleasure. It's great.
Yeah, during this episode, I went and subscribed to the fund newsletter, so everyone should go and do the same. Probably.
We'll put the link in the show notes.
Thanks, Joe.
Cool. Yeah, thanks, guys.
Hey everyone, thank you so much for watching today's episode. Really hope you enjoyed it. We wanted to take a second to just remind you about our upcoming Digital Asset Summit in London, March 18th to 20th. Santi and I got your back. Seats are limited, and we hooked you up with a 20% off discount code. It is Empire20. If you heard it earlier in the podcast, there's a little competition running at Blockworks to see who can drive the most number of tickets. So when you register for the Digital Asset Summit, make sure you use our code Empire20. See you in London.